Good afternoon. Welcome to today's LBMA webinar. We are delighted to welcome you to listen to Jeremy East and Sunil Kashyap as they provide you with LBMA's Asia update. Jeremy is LBMA's Senior Advisor in Asia, and he is also the Chief Executive of Eastwind Capital, a commodity consultancy. Prior to this, he spent 11 years with Standard Chartered Bank in Hong Kong, serving as Managing Director and Global Head of Metals Trading and Commodities for Greater China and North Asia. Also joining us today is Sunil, Managing Director, Head of Asia Commodities for the Bank of Nova Scotia in Hong Kong. With his 25-year career, he brings an in-depth understanding of both the key challenges faced and also the market forces influencing participants in the physical gold supply chain. So with that, I shall hand over to Jeremy and Sunil. So whenever you're ready, gentlemen.
Good afternoon. Well, today we're celebrating an all-time high on the gold price. Sunil, I mean, a lot of things supporting the market. What do you think?
One thing that's not supporting is jewelry demand, but otherwise, I think there is a huge momentum, and we can feel that even in Asia. Clearly, the really growth in terms of investment demand is coming from the West and mostly in North America. But even in Asia now, there's a little bit of a hysteria sort of building up, where there's lots of discussions about people think should they get in at this level or not. And I think there's definitely a feeling that we have a very positive momentum of the gold price right now.
It just feels that the US are printing dollars. These dollars have got to find a home. By buying gold, you're selling dollars, buying gold. So there's money flooding into the markets, and I even noticed that Bitcoin was over 11,000 recently. So with the buying in gold, it's sort of there's money going into other markets as well.
Right, and it's sort of an overused term, but there's definitely a gold rush right now.
Yeah.
There's more and more retail investors looking at it and saying this is the time to get in. And of course, silver is going crazy also. So.
Yeah, it's funny. Silver, when was it? Back in March, silver almost halved, or it fell something like 30% in a day. And here we are. Everyone looks at the ratio, gold-silver ratio, and now we're almost back, and now silver's caught up and overtaken.
Exactly. So it's definitely an interesting time to talk about gold. I think there's a lot of interest right now. Everyone wants to know what's happening. So it's a great time to have this discussion.
So out in Asia, we're very much involved in the physical markets, and over the past sort of 10 years, there's been a huge flow of gold really coming from the west to the east, and whether that is into China, and we've talked about that in detail in the past, or as the more traditional demand into India. Sunil, so what's going on in India? And we can talk a little bit about China later, but India, I think there's a lot of going on in terms of the physical, the imports, and
yeah, it's firstly, as far as as everyone probably knows, the virus has really hit India hard. Most of India is still under lockdown. Even in the biggest financial center, Mumbai, the local transportation is at a standstill, so people can't get to work, and so generally, the economy there has slowed down considerably. So what that has meant is jewelry demand is at a low level, but just like everywhere else in the world, there is a lot of interest in investment demand, and we're seeing that in terms of the ETF holdings going up. There's about 10 ETFs listed in the Bombay Stock Exchange, and the holdings of those ETFs have been going up. And also, just recently, a couple of weeks ago, there was an issue of a gold bond. The government in India issues what's called a sovereign gold bond, which is issued in rupees but repayable in gold terms. And that issued 7-year bond. That issue had its, I think, 4th and 5th tranche last couple of weeks ago, and that was a record tranche. They raised about 4 tons of gold in terms of deposits, 7-year deposits. And in India, the local rupee price of gold, which is denominated in rupees per 10 grams, has hit 50,000. So that's a very important
number. That's an all-time high.
It's an all-time high. And so everyone remembers last year it was 25,000. Now it's 6,000. So there's a lot of interest in the metal, especially on the investment side. Jewelry demand remains very, very slow, but retail investment demand is really good.
So if you look at India, and India over the years, people talk about India, there's something like 25,000 tons of gold in India. That's a huge uptick, in terms of the value of that gold in terms of the economy. But one of the problems I think India has is that gold, and that doesn't return to the economy, so to speak. It's not monetized. So a lot of it is in people's houses, it's in vaults, it's in like the temples. So one of the reasons for that is perhaps that India doesn't actually have a kind of an organized market.
Right. So the government is aware of it. It's the amount of gold holding is something like 2 years GDP for the country. So it's an incredible number. And so they're looking at different ways in which they can get the retail investor to bring out that gold. And there's a couple of things that the government has implemented. One is there's something called a gold monetization scheme, GMS. It's supposed to allow retail investors to bring their jewelry to a bank and convert the physical metal into a bank deposit, or basically a gold deposit, and get interest of around 2% for that. So that's something that has been launched, but really has not been successful. The sovereign bonds, on the other hand, like I said, have been very successful. They give a 2.5% return for a 7-year bond, tax-free, and again linked to the gold price. The second step that the government has taken is to implement what's called a gold spot exchange.
Right.
So they're encouraging existing exchanges to offer a gold spot venue where customers can buy and sell gold on a spot basis, and that's intended to allow for people to get comfortable with the financial aspects of gold. And there are a couple of exchanges which are looking at this now. And there have been very detailed discussions about putting in place implementation plans and probably looking at having an exchange ready by the end of this year.
Well, I mean, I think if you see what happened in China and the Shanghai Gold Exchange and the success that came through that exchange, I think if you look at India, compared to where China was at that time, India has a lot of the infrastructure already there. It already has vaults all over the country. It's very familiar with holding gold. So it's got that sort of distribution network. Whereas back in the early 2000s, when China launched the Shanghai Gold Exchange, the distribution of gold wasn't there, and it was probably only 10 years later when that was then the market really took off. But India's already got that. Another question really related to the gold bonds. Do you see that as being kind of a fundamental change for the way that Indians buy gold, or less physical, more paper?
Yeah, I think it's a very interesting subject. I think it's a beginning. It's a first step towards it. What I hear mostly is the demand really hasn't come from people who are replacing gold jewelry demand with this paper, but I think it's just putting the seed in to the retail investors' minds that there is an option available to have the upside of gold without actually buying the physical. So this is just a beginning, but I think that it'll take years, if not decades, to change the mental mindset of the Indian investor who's been doing physical buying for the last 2,000 years or so.
But it's the idea of the spot exchange. If you look at all the other exchanges around the world, it seems to be that the spot exchanges or the spot markets have performed pretty well.
They have. I mean, what's happening in Shanghai? I mean, Shanghai Gold Exchange, one has heard is going at a discount. What's the situation right now?
Well, I think in China you're seeing that the market is a little bit like India. People have been sort of selling their gold, and there's not so much retail demand. In China, the gold can't be exported, so therefore it's there. It needs to be consumed by the local market. Whereas obviously gold in Hong Kong and Singapore is freely transferable around the world. So that gold can move from an area of a discount, but perhaps in Hong Kong where it's $1 or $2 discount, to a premium which might be in New York or against London. So the adjustment of the market is much slower because it has to be sort of naturally consumed in the China market.
So I guess in the past, maybe some of that metal used to come to Hong Kong and then find its way back to Zurich and London, but probably that's not happening right now.
I think now, especially with the after the virus and the logistical difficulties and crossing borders and lockdowns, and then I think the movement of gold, hand carry gold, has been severely restricted.
Yeah, and we're seeing that in India too.
Yeah.
So what we're seeing is, in fact, gold imports have just resumed maybe 2 or 3 weeks ago, because traditionally, the demand has picked up, like I said, in terms of investment demand, and traditionally that demand would have been met maybe by import of doré or maybe hand-carried gold coming across the borders. And because of the logistical difficulties, because of the local refiners being unable to refine, you have a situation where the demand has meant that banks have started importing again, which is good in a way.
So we're kind of seeing the sort of the retail jewelry market being very soft, selling interest there. But even out here, it's so that there is buying in investments on the investment side. So it's not purely a Western demand story, but we're actually seeing that in India and also in China. People investing in the gold ETFs. So again, there is investment demand out in the East. It's just not on the same scale that we see in the West.
And do you see, what about silver? I mean, I noticed that CME has recently included a lot of silver refiners in their good delivery list. Do you think there's likelihood that silver will come out of China?
Well, I think it's a very interesting topic. I understand the Shanghai Gold Exchange, the international board, are looking at launching a new silver contract. And from the LBMA, I can say that we've seen a number of Chinese refiners getting good delivery status for silver, and I believe there are more coming through in the pipeline. So I think that means that they're trying to encourage basically a silver market in Asia, a formal silver market in Asia for physical silver, which doesn't really exist at the moment. Because if you're a silver producer in Australia or you're an exporter from China, that silver really trades at a differential to London, and there's no kind of local market for it to trade on. Ultimately, a lot of that silver will find its way to India, but there's no kind of local market in Asia for physical silver. And I think we'll see more and more interest from the regional producers to get good delivery and to have their silver traded on the Shanghai Exchange.
Okay, interesting. Talking about the Shanghai Exchange, I know that there was a very big default in China of one of the big jewelry manufacturers in China, NASDAQ listed. Maybe you can shed some light on.
Well, I don't have it. I don't have any kind of insight.
What's the impact of that?
Insight to that. I think with all these, I think there's a relationship between the price of underlying commodities and the numbers of stories and frauds that come out in them, and they tend to move together. The higher the price, the more you read about them. Just from my take on from what I understand is that I think I'm absolutely shocked in terms of the size. It's something like 80 tons of gold apparently, and I know how well controlled the vaults are from the Shanghai Gold Exchange, and there's absolutely no question regarding the exchange. And so this is something that's outside of that. And obviously the question there is related to if someone was financing against a gold inventory, a physical inventory, and it appears that that was happening. But the implications of that are actually quite severe, and in terms of, I don't believe that this was anything to do outside of China. It was purely a kind of a China story that we're seeing. But the risk departments in the banks will all be taking notice regarding ensuring collateral is there, it's correct, it's in their control. So it really kind of tightens the risk and from the banks, and also it makes it a little bit more difficult. And potentially the market for financing gold will shrink.
But hopefully it'll get more organized in the future. And some of the aspects we've seen, some of the mistakes we've seen in some of the local banks, wouldn't get repeated.
Well, I think it gives an opportunity to new entrants potentially, with the right formula, with the right arrangement in terms of vaulting, validation of the inventory, then kind of a more formalized process and very well tightly controlled by experienced market professionals, etc., etc.
Okay.
I think that then we can see an opportunity, because from where I sit is 10, 20 years ago, all the banks used to do this. Right. They'd all be financing on behalf of their clients. And today, fewer and fewer banks are in this space. But I think there's a big demand for it. Investors typically like to be liquid. So although they're investing in gold, they rather like to use that gold and then to get leverage. And of course, you get leverage on COMEX, with 5%, but they'd like to do the same in London with physical, potentially with ETF. So I can see, a big interest, and that interest is increasing as the price goes up and we see more investors.
Taylor, any questions for us?
Yes, there is something that I would like to know, and it's probably something that's more for you, Jeremy, as it's about Hong Kong. So what exactly has been the physical demand impact of having no tourists and new security laws in Hong Kong? How is this, affecting them now? How will this affect the gold market in the near, medium, and long term?
Well, I think in terms of sort of the retail market, I think it has been suffering. I think we're not seeing, we used to see thousands, tens of thousands of Chinese tourists coming to coming to Hong Kong. These huge jewelry stores like in Kowloon and Times Square. Today they're very empty. There's not really much going on there. In terms of the security law, I don't see that having any impact on the gold market. And in fact, up until quite recently, I don't know about you, Sunil, but I think that the economy in Hong Kong has really been the busiest I've seen it for a long time. So just here where we are sitting in central Hong Kong, the buses are packed, the streets are full of people. So it's the economy is coming back, I think. However, it's potentially quite fragile, and we've recently seen a little bit of a resurgence in the virus. But I think there are some other changes which are going to be coming along, which will actually sort of encourage Hong Kong in terms of its position as a financial centre. There was a recent announcement by Carrie Lam regarding this kind of a cross-border wealth management, a kind of a wealth management connect between Hong Kong and I think 11 of the largest cities in southern China, where potentially we can see in the coming years huge flows of money coming into Hong Kong in the wealth management space. And I think that is going to be potentially quite important for Hong Kong, especially in the gold market, because Hong Kong in the past has been very much a physical market conduit into China, it was more Singapore that was the wealth management side. So I think we're going to see in the next 5 years a big change in Hong Kong, money coming in wealth management, and of course Hong Kong's a big gold center. So I think we're going to see a lot more interest in gold.
I think you're right. I mean, it's very clear, both from Beijing as well as from Hong Kong, that there's a strong interest in creating a more strong connection between the mainland and Hong Kong on capital market side. The word connect that Jeremy's used, just for the sake of the listeners, is used across the board in terms of bond connect, equity connect. Now we're talking about the gold connect. So this sort of concept of trying to connect the mainland without all its capital controls with Hong Kong, where there's no capital controls, and trying to create a solution to allow foreign investment to come in into Hong Kong, and then through Hong Kong into China, and allowing mainland money to come out into Hong Kong and then go out for investment. That concept is very strongly embedded now, and I think with the current changes, Beijing will make it a point to even more strongly try to push towards reforms along that line.
And of course, we see in the local market sort of these huge IPOs that are going on, and the listings and attracting more and more capital into the Hong Kong market. And and I'm sure the Hong Kong Exchange is looking at new opportunities and new potentials in potentially in precious metals as well.
Absolutely. No, the Hong Kong Exchange's market cap is now $72 billion. It's the most highly capitalized exchange in the world, and so they have a lot of muscle, and they have the ability to spend money and structure any kind of products that they wish.
No, I think it's all so going forward. I think the future is actually pretty bright in Hong Kong, and especially with the the impact of flows coming in from China in terms of sort of capital markets and wealth management.
Yeah, good. Well, that's certainly good to hear on both counts. So thank you very much, Jeremy and Sunil, for your time and for kind of giving us an update on what's going on across Asia, because I certainly did not have all of this information at the beginning, so it's good to find out all of it. So once again, thank you. And to all our listeners, this is the last webinar for the summer. I couldn't have thought of two more wonderful guests to feature on our final webinar. We are having a short break. LBMA will be returning in September. We've been planning the schedule of the past few weeks, and we do have some incredible speakers and topics headed your way. You can still email any questions or ideas about this webinar, or about anything you'd like to see perhaps in the next upcoming webinars through to ask@lbma.org.uk. We look forward to hearing from you and to welcoming you back in autumn. So on behalf of everyone at LBMA, we hope you stay safe, healthy, and have a lovely August. So thank you, and thank you, Jeremy and Sunil.
Thank you very much.
Thank you.